Hello and welcome to the Tax Roundup for March 2014. And while the politicians have been reasonably quiet this month, the same can't be said for the regulators. There's been a huge amount of activity going on lately to make sure that the tax office can collect every available dollar of tax revenue. And with 1.2 million returns, the way to do this is with data matching. So the Inspector General of Taxation's recent report into data matching makes for some interesting reading. Now, for example, in 2012 alone, the ATO found anomalies in 1.4 million tax returns when it compared it to state-based property sales data. Only 0.2% of those have become completed cases. So with stats like that, you can see where the focus of the government is going to be. There's a huge amount of opportunity for revenue collection. But it's not just the Inspector General of Taxation talking about data matching, it's also Treasury, Mike Carruthers explains.
Now, while this item might not be directly relevant to us right now, it is definitely something to keep an eye on, and be really interesting to see how this develops over the next 3, 4, 5 months. Now, you may have seen that Treasury has released a consultation paper or discussion paper where really looking to expand the third-party reporting, data matching capabilities that the ATO has at its disposal. And in some ways, it's really seeing a little bit into the future in terms of what will the ATO be able to gather in terms of third-party information. So you may be used to, and you probably are quite used to dealing with clients at the moment where information is already provided by their banks, by share registries around things like interest payments, dividends, all those things that automatically get pre-filled into their tax returns. What the government is looking to do is expand that regime quite significantly. The sorts of things that they want the regime to cover would include certainly sales of real property, so sales of land and buildings, a streamlined data matching and reporting system being put in place around those transactions, sales of shares in companies, not just listed shares, but Treasury also talking about even private company share sales being picked up too, sales of units in unit trusts, managed funds, those sorts of things. Also things like sales, so sales data where the information might be collected through merchant systems. And the other thing that they're looking at reporting, which shouldn't be too much of a hassle for the government, is taxable government grants and other payments. So the idea being that the government or the ATO would receive all this information through some automated system that's set up. They then be able to use that in their data matching exercises in terms of looking at whether clients really are complying with their taxation obligations. So typical scenario might be you sell a property, that property sale gets reported to the State Revenue Office. State Revenue Office then has to report those details directly to the ATO. So the ATO would know that a transaction has happened. They may not know whether that was your main residence or whether that was a rental property or a commercial property that qualified for small business concessions, but they would know the transaction happened. And the idea would be that they would know that within a fairly short period of time. So something to keep an eye out on. As I say, at the moment it's just a discussion paper, but the planned start date for this expanded regime is 1 July this year, 2014. So we'll see what happens over the coming months, but definitely one to keep an eye out on.
In IDs this month, Adnan Sibai looks at family trust elections and what happens when your test individual isn't alive at the time you make the election.
This ID looks at the importance of timing for the purpose of making family trust elections, and we'll call them FTEs. As we know, to make a valid FTE, you need to choose someone that is alive at the time of making the choice. This ID looks at a situation where a taxpayer or a trust specifically makes a FTE and backdates it for a number of years. At the time of making the choice, the person is deceased, so this test individual is deceased, but at the time the backdated FTE election applies, that person was actually still alive. Very kind of technical argument, but the ATO has said, no, if the person is deceased at the time of making the choice, you can't make an FTE in regard to that person. You have to choose some person that is alive. So, important lesson here is, look, make sure you choose the right test individual when making an FTE, but also, if you are thinking of deferring the choice until a year where you have to, think carefully because you might adversely affect your options later on down the track.
In cases this month, Adnan Sibai looks at a case that provides some much needed clarity around the differences between a business of renting property and just being a landlord.
This case finally gives us some guidance on what is considered carrying on a business of renting property. Now, as we know in the past, we haven't had firm guidance, and really all we know is that renting one property is not carrying on a rental property business, and renting 100 properties is carrying on a rental property business. We finally do have some practical guidance on things we should be looking out for. Ultimately, in this case, there was a taxpayer that was renting with her husband 9 rental properties. The Commissioner argued they weren't carrying on a business and so weren't entitled to business type deductions. The Tribunal said no, that's actually not the case. Because the taxpayer was able to prove that, one, they actively managed the properties themselves, they did use property agents, but they managed those property agents and helped deal with some of the issues that came up with the properties. Because they rented 9 of them, and because there was a pattern of trading or activity that the taxpayer could show or point to, the Tribunal said yes, you were carrying on a property rental business. Now, one thing the Tribunal noted was the fact that the taxpayer had poor record keeping. That actually could have jeopardised the entitlement to argue that the taxpayer was carrying on a rental property business. On balance, however, the Tribunal said, yep, carrying on a property rental business, but believe it or not, because there was poor record keeping, no deductions were allowed anyway. So great argument, unfortunately fell down on the details, and that's an important lesson for all of us. Great, we can prove we're carrying on a rental property business, but very important to claim or to prove the deductions you're claiming.
And that's the tax roundup for this month. Remember, this year will be an absolute sea of change. If you want to keep on top of things, have a look at what Knowledge Shop has to offer. Just go to knowledgeshop.com.au or give Ray a call on 1800 800 232. We'll talk to you soon.